Good morning. Welcome to the program. Lots of breaking news to get you through. I think this first graphic on markets will tell you most things you need to know, not everything else. But as you can see, we're looking at dollar on the way. Dollar yen, U.S. futures. We have a lot of breaking news coming through. Lisa Cook is being removed effective immediately. We have some new tariff threats coming out of Donald Trump. We have a Chinese onshore market rally that is exhibiting a lot more signs of overheating, 2% higher to the upside yesterday. Dollar dropping, steeper as far as the curve goes. And as you can see, gold futures are now punching 0.4 to 1% to the upside. Equities are down. Taiwan is coming online. We're looking at declines to 0.25%. There we go. Steeper curve, 2s and 10s, do the math across the curve all the way through to the 30-year yield. Looking at futures right now going into the open today, A50 futures, where we had dollar China going into this morning at 1 month highs or 1 month lows. We'll look at the fix today, which was an anchor for risk assets. Might that be and might that serve the same purpose today? We're looking at a 10-year yield at 177 right now in the 10-year yield. We are looking at declines going into the Tuesday session ahead.
Yeah, it looks like, things are quiet, things are looking pretty good. We're focusing on Powell, and then all of a sudden the president starts posting things on social media, and things can turn south pretty quickly here. So certainly this is one thing we're watching, even in the China equity story, which is kind of a standalone thing here. Maybe things are looking a little bit overheated, right? That's why we are seeing futures slightly lower here today. We have been watching some of those overheating signs after we saw turnover top 3 trillion renminbi, which is the second highest on record yesterday on the onshore market. A lot of it had to do with what we heard from Shanghai. So easing some home buying curbs as well. So we'll still watch the property space. Some of these names like Wong, for example, was limit up even before that sort of announcement. So certainly one to watch. We have some July trade data coming out of Hong Kong, and there's an energy briefing in Beijing today.
Yep, earnings as well on deck today. So we'll look for market reaction to earnings yesterday, and of course some names to look ahead to. I won't spend too much time on these names coming through, but of course you have the likes of some big gold miners like Zijin Mining. Ping An is on deck today, as with Nongfu Spring, and of course very upstream, massive energy player PetroChina. Of course, Yvonne is also pointing out top of the next hour is a briefing on energy, so we'll watch out for that among the many things we'll be tracking going into the open today.
Yeah, so the rally is one thing. Maybe we could put that aside for now, because what's happening the last few hours has been what's been going on with Lisa Cook, right? Which did kind of shock the market in some ways. Whether there is legal recourse here, that certainly is a question, but also, does this in some ways bring up the whole concern about Fed independence once again?
Yeah, I mean, initially what we saw was a reaction in FX and rates. So the dollar was sold off. Dollar yen was one of the initial things we were tracking as well. And I think if you look at it over 3 days, right, you had Jackson Hole, you had a move down in the dollar there, you had a rebound yesterday in the Bloomberg Dollar Index, and we're coming off a little bit right now as far as that is concerned. Now, it might also be slightly confusing when you look at cross-asset, because we're also getting separate news coming out of a separate Truth Social post coming Donald Trump talking about export restrictions here. And that might be why equities are continuing to be under pressure as we speak.
So export curbs on chips, right? He says that's something that he could actually look into over digital taxes. So certainly that leaves to a lot of the equity space seeing a little pressure here, as you mentioned. But yes, this did come off of after this meeting with the South Korean president as well. So not sure what was really discussed in that meeting when it came to chips alone. But certainly that is something that is a potential headwind here. Let's talk a little bit more about the top story here right now. President Trump removing Fed Governor Lisa Cook from her post at the Fed after allegations that she falsified documents on mortgage applications. Let's bring our U.S. economy editor, Laura Curtis. She is with us right now. Laura, it seems like the president escalating pressure on the Fed once again.
That's right. This follows weeks and weeks and weeks of Trump putting pressure on Fed Chair Jerome Powell to cut interest rates, lobbing insults at him on his social media feed, that kind of thing. This is different, though. This is the first time that Trump has actually removed or said he's going to remove a Fed official. So it's a real escalation here, it does come just a few weeks before the next federal meeting of federal officials they'll discuss interest rates and whether to cut. So lot riding on this one.
Laura, David here. So what happens next?
Well, we're waiting now for comment from Governor Cook. She, it's not clear whether or not she's going to challenge this in court. She may also just take it. We have not had any comment from her yet. we did hear from the Federal Reserve that they were not prepared to comment on this one. So, we're just waiting now to see kind of, if she's let in the building tomorrow, essentially, or if she just takes the news and moves on. But yeah, the big question around whether she does challenge this in court, what happens in the intervening time? Does she, get to keep doing her job while this plays out, or a lot is still pretty uncertain, which is not unusual for Washington these days.
Laura, can you tell us a little bit more if Trump actually succeeds with this removal of Cook? How does it change the dynamics within the board now, the 7-seat board now?
Well, it would give Trump potentially another ally on the board. He's got one on his way in, but Myron is not confirmed yet, and so it could definitely sway the voters at the Fed to be more in line with Trump and when it comes to interest rates. He's obviously in favor of cutting them. It's not clear whether other governors are necessarily sort of Trump's people, regardless of when they were appointed, when they came to the board. But yeah, it definitely gives Trump another seat if it does stick. So he'll have 2 coming up.
All right, Laura, thank you so much. Laura Curtis there, great context, joining us out of LA. As economy editor, and certainly a lot of things to watch, a lot of development still, lots of confirmations, by the way, still that we have actually yet to see. Just to also mention here, so we're looking at market reaction, and it's going to come up on your screens very, very shortly here. The U.S. 2- and 10-year yield curve is now the steepest in 4 months. Dollars under pressure. There we go on your screens. Not this one. Can we get the other one, please, as well? And we're looking at U.S. futures also continuing to be under pressure. We'll get to that one in a moment because that's the other big story that we're tracking here as well. But yeah, VIX futures are punching higher as I speak.
Obviously, it sparks uncertainty, as Laura mentioned, right? If Trump succeeds, this means that there's probably 4 board members that could be aligning with his view of maybe turning a bit more dovish, right? So certainly the makeup is very interesting. The timing is very interesting as well. But some say, despite all these questions, it basically reinforces the Trump playbook that he wants lower rates in general. So certainly there's a lot of questions of market, Fed intervention, Fed independence, and certainly that's why we're seeing the market kind of, right now, the knee-jerk reaction that we're seeing here.
There we go. We'll get you more updates once we have more confirmation and information really on many of the other facets to this story. The other thing we just want to talk about, and you might have seen it already, is really this red-hot rally taking place in the onshore markets. Futures are pointing to some downside right now, but just to give you a sense of how quickly and how fast and in a short amount of time this rally is actually taking place. CSI 300, the percentage of its members that are now exhibiting overbought signs are now at about 40%. So that's a level we don't normally see. This is a chart that takes you back, in fact, about 11 years or so. And as you can see, so we are not so much in uncharted territory, but certainly as far as the tail risk goes, we are towards the tail end of these bell curves. Let's bring in Winnie Sue, of course, our Asia equities reporter, to talk us through this. Signs of overheating. Winnie.
Yeah, we're seeing more of that, right? Yvonne just now talked about the turnover at 3 trillion yuan, second largest ever that we're seeing, and also the RSI over 80, so that's above the 70 level that we're seeing for both the onshore benchmarks, and also valuation is no longer looking cheap. For CSI 300, about 15 times forward earnings right now, which is at the level of 2022. So we're seeing these technical indicators showing some overheating. And take a step back. When we just look at how the benchmarks have performed so far this month, CSI 300 up about 10%, and also the SH comp about 9%. So both of them are now, if we look at the monthly performance, one of the top performing gauges worldwide. And actually, although there are some signs of overheating, some of the other indicators are looking a bit calmer, with the SH Comp 10-day volatility still about record low. And when you look at the percentage of margin purchase as a percent of the overall turnover, it's also pretty low as well. So there are some signs of kind of that calmness in the market, which potentially can show that this rally might not be just kind of a boom and bust. It can have some sustainability there.
People like to compare this to 2015. And maybe that's why they say that there could be a bubble in the making here. But what are the parallels and what are the differences?
Right. So we actually had that article out over the weekend analyzing the similarities and differences. And yes, actually, a lot of the similarity there around just where the ACH comp is now trading, about the level around 2015, and also the margin levels are there. And that similarity of the overall deflationary environment, right, is bringing people back to what happened in 2015. And actually, well, we won't really say that there is a bubble already at this very slow pace going up and more calmness. However, there are some early signs, or let's say the elements of bubble. And when we talked to the strategist Hao Hong, who called the 2015 boom and bust, he was saying that the elements are there, being the liquidity is there and the retail frenzy started to pick up. And also we need a picture, a story to believe in. And in this case, it's the improvement in the U.S. and China relationship. So the bubble is not there yet, and he's calling about 5,000 at ACH comp level, and we're still quite a distance from there. Okay. But it's something that investors are being more cautious about.
Yeah, HSBC also raising their targets there for SH Company 4,000 by year end. Winnie Xu, our Asia equities reporter, there with an update on what to watch out for here this morning. Coming up next, we're going to hear from BNP Paribas. They still remain positive when it comes to Chinese stocks, and Grace Tam says they still see that AH share premium likely to widen again. We're counting down the opens in Shanghai, Shenzhen, and Hong Kong. This is the China Show. All right, we're checking China. Well, futures here are slightly to the downside here today. It is a risk-off day, just given some of the breaking news that we've seen with Trump removing Lisa Cook. Also, when it comes to threatening these export curbs on chips. So certainly, but also the signs of overheating in these Chinese markets could be a sign of maybe things could be in a retreat here today. Here with us now is Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management Hong Kong. They've been calling it a liquidity-driven rally. It's something that is, deflationary, bull markets and the like. How should I be looking at this Chinese market now?
Yeah, I think especially for the onshore Asian markets, it looks much like it's catching up. Because, as we all know, for the Hong Kong H shares, this year actually has been, performed very well. But A shares is just catching up recently. And, especially for over the past few weeks, of course, for A shares, it's pretty sharp jump. And a lot of people saying is actually getting ahead of fundamentals, because when we look at especially economic data is actually slowing rather than we're seeing any good rebound. But I think as long as especially when the economy is slowing, that actually raise people's expectation, especially on more stimulus or supportive policies measures. Yeah.
So what do you make of the valuation right now? Is it still within the fair range of I wouldn't say projections, but fair range given the current underlying economic condition?
Yeah, I think especially for Asia markets, I think it's just started. So in terms of valuations, and it's not really that stretched. And of course, we need to see earnings. If earnings could continue to improve, that will help. In terms of valuations, I think for the recent earnings, results so far, especially for the Asia market, is not really that fantastic, and that's why we are seeing this is more like a valuation re-ratings rather than there's earnings catching up. But if we are going to see more domestic stimulus measure, especially for now, as we all know, China is engaged in the anti-involution campaign. So I think it's reasonably to hope, to see maybe more measures to especially to support the domestic demand, and that may continue to help, especially for all the anti-inflation. It also like ending price wars and hopefully helping like profit margin, right? So that may help earnings going forward, and that could, of course, help the valuations. But I mean, comparatively speaking, especially when we compare like the U.S. is really more expensive. So I mean, for China, A shares or H shares, I think relatively speaking, they're still like reasonable in terms of valuations.
Yeah, despite this sort of dichotomy of, right, the economic fundamentals, the earnings is not quite there to match this rally. There's still plenty of thematic plays, right? As you mentioned, anti-involution. Is that why you think there's still so much interest in this market, right? Whether it's anti-involution, whether it's biotech, that keeps, and AI that seems to be underpinning this rally.
Yeah, I think, especially I think recently, like yesterday, China announced like some property measures for Shanghai easing, and actually this is like 2 weeks after Beijing's very similar measures, and that actually rates helps for like more measures to support the property sectors, and of course, as we mentioned, the anti-involution campaigns. And once they have the campaigns, people saying this is actually like the supply side structural reform 2.0.
Yeah.
So I think they're doing something, but I think we're people are like waiting or with the hopes that they're going to do more. Because when we look at like all the facts, especially like on the consumptions side, more need to be done. But at the same time, I think there is actually still a lot of money on the sidelines. As we all know, like savings actually is huge in China. So, especially with the recent performance in the Asia market, which is like picking up, there could be like more retail investors like jumping in again, yeah.
Our producer, Anthony, actually just flagged to your point this note from Western Securities. 14 trillion in deposits might actually continue to provide that liquidity that this market seems to need, and it seems to be the only thing this market needs. Let's put it that way for now. What's your view on macro? There's a Fed conversation, 25 basis point cut. Do we expect? Well, can we position for further cuts ahead? Is it a weaker dollar? How are we set up going into the last 4 months?
Yeah, I think like in September, like 25 basis point cut is almost like a done deal. But we still have like the PCE inflation numbers upcoming, and also the non-farm payrolls, and that's the key macro numbers that we need to be closely watch. And I think like 25 basis point cut is almost like fully priced in. I think the market will look for like if it's really a very weak job data, then the market may start to bet on like it's not 25 but 50 basis point. That's chance like that. Right. Yeah.
What's the advice to clients now? I'm taking a look at it's a down day today. Do I still add to risk?
Yeah, we actually think that especially like August and September is usually seasonality speaking, that's weaker months, and that actually also provide very good opportunities to add, because usually for the fourth quarter we have a good good rally, especially like year-end rally. So any weaknesses that happen in coming weeks, September's, we think that could be like very good adding opportunities, because the Fed is cutting, liquidity is still very abundant, and there's a lot of like cash on the sidelines. For example, like money market funds AUMs over 7 trillion. So if people started to see the deposit rate or the interest rate is going down, they have to find better channels, right? And then like for bonds and also for like equities, of course, the potential returns could be higher. Yeah. So we're actually thinking there could be like a shift, like from cash to could be bonds, could be equities. Yeah.
Grace, thank you so much.
Yeah, thank you.
Grace Tam there, Chief Investment Advisor at BNP Paribas Wealth Management here in in Hong Kong. Going into the open today, we're looking at the declines half of 1% on the Hang Seng Index. Among the movers, we'll talk about on the other side of this break, Haidilao Lau down about 3%, getting tossed into hot water after lukewarm earnings coming through. More on that and more, plenty more ahead.
All right, we're taking a look at when it comes to macro side of things here, just given the removal of Lisa Cook by the president here this morning. So we are seeing U.S. futures are down. Dollar is also down. That seems to be the knee-jerk reaction that we're seeing so far here as well. And Asia is also seeing a bit of a pullback when it comes to stocks here this morning.
Yeah, we're not getting the anchor that we did yesterday coming out of the FIX. So in fact, not a big change as far as that was concerned. So we are looking at, we were looking at Haidi Lao. Are we looking at Haidi Lao? I guess we could do it later, but that's a glimpse of what we'll talk about later, I guess. 0.5% to the downside. Southbound flow is very interesting. We'll unpack this a bit later on, but the turnover you're seeing onshore plus the negative, the net selling that we had over the Stock Connect, southbound part of the Stock Connect yesterday is indicative perhaps of more flows coming through again in favor of onshore markets. So we are still following the direction of liquidity, and that gets us into Haidi Lao.
Yeah, just when we were talking about AH share parity premium, we're going back to that premium coming back. But yeah, take a look at Haidi Lao, right? So this obviously is what we see in the earnings side of things. So analysts are pretty disappointed by the first half. So they missed estimates. They said it's a challenging operating environment. There's a shortfall in the weaker gross profit margins and higher other expenses. But just goes to show, Dino's also holding back. Also, there's a lot of competition in this space as well. So shares are down some 3%. Ganfeng Lithium, that one is also talking about a share placement there.
Yeah.
So they're raising 2.5 billion Hong Kong dollars from that placement. Shares down about 2%.
Yeah, so it's placement convertible bonds at 29.28 a piece on that placement. We will leave you with a live look at the Hong Kong Exchange, where yet again another company is debuting here in the city, and it's a good first day at school. 55%. The opening bell is just ahead. Good morning and welcome to the program. Hope you're all well. We woke up today with what was supposed to be a quiet Tuesday, and then this flurry of breaking news from Lisa Cook, Donald Trump, more tariffs. That's point number 2 and 3, I believe. And then we also have this conversation around this Asia market rally with, I think, nearly 40% of the CSI 300 now exhibiting overheating signs. I think RSI above 70 as far as constituency is concerned. And then, of course, we have this listing coming through as well today, 6960 Hong Kong. We're looking at 55% to the upside on, again, simply just the latest company of this very long list already. And we're barely into September. No, we're not in September just yet. So, yep, here we go. We will wait. 他们好像是 delayed 吗? Okay, I think there was a little bit of a delay there, but you know, this is actually how the office committee greets every time Yvonne comes into the office.
No.
There we go.
No.
I sneak into the back door.
That's the last thing I want.
And then when Yvonne walks in the
middle
building,
of the morning.
this is how security acts. There we go. 55% to the upside. Anyway, on that note, here's Yvonne. She's back in the building.
Yeah, you know, you need that for a wake up, right, at 5 a.m. in the morning. I don't need coffee. I just need a gong. You take a look when it comes to this, right? So another listing to add to the mix here for Hong Kong Exchange. So certainly is a good day, despite all the kind of crosswinds that we're seeing in this market, right? As you've mentioned, signs of overheating. You talk about trade war escalating there a little bit here. And of course, the removal of Lisa Cook by President Trump. And we're still doing pretty well for Shuangdeng Group, the battery maker in China. So certainly a good debut there. The rest of the market is looking like this here right now. So we are seeing a bit of retreat right now, but this is after what was a pretty robust rally yesterday, right? You talk about the 2% gains in the CSI 300. There you go, that line there. Turnover in the onshore market topped 3 trillion renminbi. That's the second highest on record. So you know, it just goes to show, right? There is still a lot of liquidity in the system here right now to keep this rally going. But then again, today, we are hitting the pause button just a bit here, maybe a bit of a breather here right now. That's why perhaps we're seeing a little bit of a buy in the 30-year yield, so maybe a little bit into the bond space, but not too much right now. We're watching, of course, very closely what happens to the renminbi. So we are getting on track to now getting to the strongest since November for that currency, just given the dollar moves we've seen, whether it's with Fed, you know, Jay Powell, what he said at Jackson Hole, and then, of course, the Trump lines here this morning on Lisa Cook. So there you go. The property space was a big one yesterday on the back of Shanghai easing some of these home buying curbs. So there is a lot of speculation out there right now that perhaps maybe more cities in tier 1 cities are going to join in. Maybe Shenzhen is next. If that's the case, are we likely likely to see more stimulus in the property side of things. The property space, I've been heard, is not actually doing too much, but some of these companies were actually limit up yesterday here as well. So you take a look at how Hong Kong is doing here. We are seeing a bit of a pullback. We're around that 25,700 level here this morning. But yes, HSBC, I think, was the latest just yesterday, upgrading their year-end targets for CSI 300 in particular, as well as in Shenzhen. They're saying, look, the liquidity side of things can continue for some time now, and they are focusing on those big mega themes that we've been talking about, AI and the like. Right now, we're seeing HS Tech is the biggest drag here. We're down about a 1% here. So what is the biggest drag? It's the Babas, it's the Baidus here this morning as well. We're watching some of the earnings that are crossing through here today as well, particularly when it comes to Haidi Lao. So there's an NDRC meeting. So there were companies that did meet with the NDRC, and they were talking about fair competition, so how to expand demand. So this whole anti-involution theme seems to be making way for some of these companies. Not a whole lot of price movement on some of these stocks as well. But then earnings is still going to be a big driver, too, today of some of the price action today. Talk about Haidi Lao. So there's a lot of competition. Obviously, people are not really dining out as much. Maybe that's also part of the whole consumption story. And so gross margins were definitely taking a hit and was a bit disappointed by the sell side. And really, there's still a lot of competition, right? So there you go. 6% down for Haidi Lao. Watching Luxshare, Precision, Lens Tech, and Shenzhen Innovents also did report as well, Dave. But you've been talking about some of these darlings in the market here right now. And yeah, some of them, of course, we talk about the tech space, but there are, some names now that we are kind of emerging, right? I think Cambricon. Yeah. We got to add that to our vocabulary now.
Yeah. This is something you didn't know what the stock was doing before, right? You didn't even know about this company, right? Okay, so here's a quick intro in a moment. But yeah, to Yvonne's point, right, suddenly we're looking at, a stock, a name like Cambricon, for example, and just into the close yesterday, again, 14-day RSI, the 10 hottest stocks based on momentum. You just go through the list, 92 on one, and then you go through the list. This is on the CSI 300 as of the close yesterday, right? So chasing whether that's limit up or simply just pivot back to, is this an NVIDIA play if you think about it, or not an NVIDIA play, the opposite of that? Now, closer look. So how much is the stock worth? How much has it gone up? What's the latest catalyst? And I think the Goldman call yesterday, which came out, and I think the price target for the stock, change the page, please. No, not this one. There's another one. This is Pinduoduo, which came out with earnings. Do we have that? Thank you so much. Okay. So, on your bingo card last year, 550% on this name over 12 months. Goldman then raised their price target to 1,800. The consensus, by the way, among four, including Goldman, is just north of 1,000. It's just trading at a current PE of 4,500. But if you extrapolate earnings further, that goes down to 424 at the end of this year, and then goes down even further if you look 12 months ahead from today to 292. So I don't know, is stock expensive or is this still a momentum play? Anyway, you can make that distinction.
Yeah, they basically lifted it by 50%, Goldman. Just talking overall, just the R&D investment side of things, the back of rising CapEx among some of these cloud providers in China. So certainly that is still that AI theme that is still happening here. But yeah, as you mentioned, I think you meant some of these Star 50 ETFs, right? The premium on them basically shot up
at a record
yesterday because of names like Cambricon.
Yeah, I think 6.2% was the premium on that specific stock. Plus, of course, the other thing, turnover, southbound, I think we can get to that later. PDD, of course, which was a company and a market cap that I think at one point, I forget when it was, that we were comparing this to Alibaba, weren't we?
At some point, when the whole Temu sort of craze, happened, certainly that was one thing. People were kind of fearing this was going to be a weak set of earnings, but they still did okay, right? So the U.S. listed shares, or the ADRs, they actually closed higher after we did see better than expected second quarter earnings. So China wrapping up stimulus to try to galvanize consumers. You also have, what's been going on with U.S. tariffs, which, certainly did hit the company in some ways. So Bloomberg Intelligence believes that early signs suggest profitability may remain resilient there. Let's bring in our senior consumer and technology analyst, Catherine Lim. She joins us now. How sustainable is this sort of profitability at PDD when you start to see gross margins have fallen to record lows, Catherine?
Right. You know, it is interesting that repeatedly the company highlighted that, you know, the trajectory for the profitability and the margins, there's a lot of uncertainties to that. And I think it really comes back down to the business model is evolving for PDD and Temu. It's great that the company actually beat for the first time in 4 quarters on the earnings front. But really, I think the expectations are just so low, Yvonne. And, you know, right now, I think the trajectory, right, we'll have to actually see how the company progressed in new markets. And we've actually seen some of the news flow coming through that, you know, the LATAM markets, whether it's Mexico, etc., they're trying to actually clamp down on de minimis or low value items too. So lots going on outside of China. And I think, you know, that's the $1 million question. We'll have to see how the company deliver over the next few quarters.
Well, is this deliberately on the part of, you know, should investors look at this as a deliberate strategy long term?
Right. Good question, David. Really, I think the company is out to support the Chinese suppliers that's actually selling on its platform itself. And there's this whole big push to actually help these Chinese suppliers go overseas, you know, create more businesses, you know, draw in more customers. So I do think that, you know, the margins going forward will not hit historical highs, but rather it's now a question of what is the new normal for PDD.
Can you tell us more about, you know, by subsidizing suppliers, there's this kind of 100 billion renminbi support program. I mean, it seems that the company is really shouldering some of these higher logistics and fulfillment costs as well. Does this model risk permanently compressing their margins?
Right, Yvonne, you know what? You're going to actually hear more from Meituan and Alibaba this week itself, that they themselves are throwing in the subsidies and the support for merchants on their platforms. And, you know, along with perks for shoppers, we're talking about both in China as well as overseas. So, you know, this is not unique to PDD. Again, you know, there is a big push for businesses and consumption to for that engine to continue in China. So I do think that, you know, this is the effects of that.
Okay. Thank you so much. Catherine Lim, our senior analyst over in Singapore for us there. We've alluded to this, and it's certainly one broader theme we'll track today, right? Flows between the two, and certainly the proxies for what those flows look like. So number one is obviously turnover. We've been obsessing over that, 3.3 yesterday. Net selling over to Stock Connect yesterday, AH premium has dropped to about 25%. And this was the other one that Yvonne was pointing out earlier. The Starboard ETF premium, because of the likes of some of the A shares listed there, are actually now at a record of about 6.2%. Right, so how do you play this market? Where do you make the money? Eric Wong, CIO of Stillpoint Investments, joins us here on set. Good morning, sir. How are you?
Good. Thanks for having me.
So what have you guys been busy with? What is taking up most of your mind space these days?
Well, we're certainly watching those southbound flows that you mentioned. But beyond that, the consumer spending shifts, as well as what you mentioned earlier about the AI spending, maybe not around CambraCon, but some of the other stocks that we're excited about continue to keep us busy and very excited about the opportunities.
Yeah, how do you still play that? If it's not CambraCon, what is the sort of play around AI now?
Well, when we think about it, the Chinese hyperscalers like ByteDance, Tencent, Alibaba, they are unleashing a surge in CapEx, and much of that is going to AI infrastructure, like data centers. And so what we're seeing is that this CapEx broadly for the whole group is going to go up more than 60% this year. And at the same time, you have these Chinese data center operators like GDS, like VNet, that are trading at 12 to 13 times EV to EBITDA. We're not talking about 4,000 times PE ratios.
Oh, that helps, actually.
But 12 to 13 times EV to EBITDA, while their global peers are trading at more than 20 times. At the same time, these Chinese data center operators are actually spinning out their domestic assets in the A-share REIT space at EV/EBITDA multiples of 18 plus. So when we think about the EBITDA growth momentum and we think about the re-rating opportunity, we get very excited about this space from a thematic perspective.
And, you know, are gems like this, for example, valuation gems, still easy to find in this market, given how far it's rallied? Just to help us understand where you are.
Well,
now.
when we think about what the market looked like in August of 2024, right? These gems were lying around everywhere.
Okay.
Now they're still there. We just have to look harder, and I think it's much more of a stock picker's market than a beta market at this point.
Okay, AI is certainly one. You look at new consumption. I mean, that's certainly very hot as well. Are there places that are not crowded in this whole kind of theme now?
Well, the answer is yes and no, right? I mean, as we've seen with new consumption this year, consumption spending is relatively conservative, it's subdued, but we're also seeing a lot of spending shifting towards what we call the happiness economy, collectibles, experiences, self-expression. And you could say stocks like PopMart, which are, you could argue that it's crowded, right, are actually tapping into the zeitgeist of this and able to deliver rapid growth that is much faster than general consumption in China, right? And these stocks, they look to be expensive, but our view is that the growth from a revenue and an earnings perspective more than justifies that premium. So it's really not about how much these consumers are spending, but where that cash is going. Now, you ask about whether these are crowded or not.
Yeah.
Our view is that a name like PopMart is very well known at this point, right? But this type of spending in the consumer space continues and it's thriving, and there are small stocks out there in the A space that benefit from this rapid shift towards the happiness economy.
And what criteria would you use
To make it happy.
Yeah. Apart from making you happy, because there are lots of things that make you happy that get you into trouble. But let's look at it from a stock perspective, right? How do I spot the next PopMart?
Yeah.
Well, we spend a lot of time observing what's happening on social media, heat indexes around certain product launches, and those oftentimes give us a lay of the land in terms of what might be rising, in terms of consumer interest, and what might be picking up in terms of the heat index on social media. And so those are ways that we try to suss out some of these opportunities.
Like what? Can you give me an example of what's the next Labubu that everyone's...
Well, it's so interesting. Everyone's talking about Labubu with PopMart, but if you look at the domestic sales of PopMart and how their IP is broken down this year, actually the Monster series, to which Labubu belongs, is not the most dominant IP. It's actually Dino, right? And so even within the PopMart IP portfolio, there are emerging ideas and IP there that we think could be potentially the next big thing.
And, we're not, because these are by virtue new consumption names. If you think about it, new product categories, right? How visible are it? We're not used to trying to extrapolate these businesses 2-3 years down the road, right? There was concern around how visible are earnings for just PopMart as an example.
And how do you separate this from just being some sort of fad?
Yeah.
Our view is that, to be totally honest, many of these are fads. And how do we separate out which ones are more sustainable and which ones are just one-time fads? To the extent that a business can actually build a platform where they can use consumer feedback to drive the next exciting IP, that becomes a flywheel that can become more sustainable. And there are some businesses in this space that are able to do that, and some that are still trying to build it, and some that we believe probably are just a quick fad and then on to the next thing.
Right. And, a lot of these names have been looped into this general category of affordable luxury.
Yep.
And I wonder, as you look for these stocks, do they need to not be in the high price point categories?
Like a Laopu Gold.
Like a Laopu Gold.
That focuses a bit on,
Well, I mean, luxury itself is probably not benefiting from the consumption environment that we're seeing.
Right.
But specifically on Laopu, for example, beyond just the fact that you're buying a piece of jewelry for a high price, you're able to buy gold, which also has some storage value. And at the same time, you might be trading down from a European luxury brand to buy Laopu.
Yeah.
So it's all relative in terms of how people look at these price points.
It's a haven play and a luxury.
Yeah, and if someone breaks up with you, right, that's the downgrade, right? I'm downgrading you from just to mention, this is, it used to be Bulgaria, but now here you...
But I would argue it's also aspiring for some that weren't buying it before.
Yeah.
That's correct, yeah. I'm just using your trading down.
Cuts both ways.
I was looking, there's an overlap between people that buy into LVs and the Richemonts of the world with Laopu Gold. That sort of Venn diagram is getting bigger and bigger now.
Interesting.
But interesting. I want to ask one more question. Precision manufacturing.
Yes.
That's also a theme you're watching out for a while.
Yes. Well, on the face of it, tariffs are actually headwinds. But there are a small group of companies that are actually making these tariffs their tailwinds. right? From a logical perspective, these tariffs are actually placing pressure on manufacturers in China. But there are some companies that are actually poised to benefit and take advantage of these geopolitical tensions because they're actually helping the U.S. expand their manufacturing capacity. And despite this advantage that they have, many of these stocks are still trading at single-digit PE multiples and near double-digit free cash flow yields. So this gap between market perception and business reality for this small group of companies is very exciting for us.
Final question for you. I think your fund is up 36% year to date. Just fair disclosure, you own most of these themes that you just talked about?
In our portfolio, these themes are quite present and continue to be excited about them.
Fantastic. Thank you.
Yeah.
Thank you for coming in. Yeah.
Great to have you. Eric Wong there, CIO of Stillpoint Investments. Coming up, Shanghai relaxes housing curves with media reports saying Shenzhen may be next. We have details on those moves just ahead. This is Bloomberg. Watching some of these property names, they were pretty hot yesterday on the back of this news of Shanghai easing home buying rules. We've come off that a little bit here today. So the likes of Shimo property is down some 5%. So let's get more on, of course, what could be next, right? Local reports are saying maybe the southern tech hub of Shenzhen could follow suit with more easing of curbs. Let's cross over to Beijing and our China correspondent, Min Lo. Shanghai, they're talking about now eligible residents can purchase unlimited homes in suburban areas. How new is this?
Yes, I wouldn't say that it's very new because among all the first-tier cities, Guangzhou was the first to loosen all purchasing restrictions, meaning you can buy unlimited homes throughout the whole city. But then since then, we had seen Beijing started to loosen restrictions in August, and now Shanghai is following suit. What Shanghai is doing is to allow eligible residents to buy unlimited homes in the suburban areas. In the urban areas, eligible residents, including those that have paid pension for at least 3 years, they can buy new homes now, not just second-hand homes. So this would go some way to destock the excess housing inventory in Shanghai, because an estimated 80% of their unsold homes are in the suburban areas. So Shenzhen might be the last to follow among the first-tier cities. We had also seen some second-tier cities already loosening these purchase restrictions as well.
Yeah, and Min, on top of this, there's also some more measures to support things like taking out a mortgage or dealing with the tax burden of purchasing big property. Walk us through what the latest is here.
Yeah, what I would say is unique to Shanghai that Beijing hasn't done is that it is explicitly removing the differences between the mortgage rates for first and second-hand homes. So last year we did see the PBOC removing the distinction for down payment ratios for first and second homes, but this time Shanghai is removing the differences for the mortgage rates. And on top of that, they are also now allowing the use of these housing provident funds. People can now tap into that to pay for their down payments for their house. So the housing provident fund is something that people pay into that can help them support their home purchases. But in the past, there had been a lot of restrictions, right? You can't tap into it for the down payment ratio. There are restrictions based on how much you contribute to it, based on your marital status as well. But this time, Shanghai is also increasing the quota of those funds by 15%. You can use those funds to pay for your housing, and that fund offers lower interest rates compared to a regular mortgage you take out from the bank, generally about 45 basis points lower. So nationally, we are already seeing a lot of places also loosening restrictions. So more people are using that fund to buy their homes instead of taking out mortgages. So again, Shanghai is doing this. We are starting to see the Securities Time reporting that other localities like Suzhou are also looking into it as well. And generally, there is anticipation that given what Shanghai is doing, it's also loosening the property tax rules. For example, your first home will be exempted from taxes, your second home as well, up to a certain 60 square meters or so will be exempted from taxes. Given all of that, we might see other cities continue to follow suit as well.
Min, thank you so much. Min Lo, our China correspondent there at the capital in Beijing, for us looking at markets. Bulls are taking a break, and so will we. But we'll be back, and hopefully they will too. This is Bloomberg. Okay, just a look at markets right now. We're looking at rare earths. I mean, the news flow does suggest perhaps, or does give a reason behind the declines, but then again, you have to also consider the move up in markets with, even without the news alone, maybe this is what we would have gotten anyway, as far as rare earths are concerned. Just speaking of that as well, one group that's moving against the grain today is really the gaming stocks here, and as you can see, with the exception of Tencent, which is, by the way, doing well, relatively speaking, to the rest of the market. Gaming approval signaling decent support there. Lisa Cook, the conversation there, dollar. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. And yeah, we are taking a bit of a breather in this rally here today. We are slightly to the downside, about a third of 1%. So it's marginally lower here. The rest of the market has obviously been dealing with a lot of news externally, whether it's President Trump, his move to fire Lisa Cook, the Fed governor also threatening more tariffs to like. So certainly things are picking up again when it comes to news.
Yeah, suddenly
to say the least.
We needed to throw our rundown out, most of it at least, going into the open today. What has remained consistent, though, is we're still tracking what was a rally and has now been a cooling of a broader pullback across risk assets right now. On the CSI 300, as you can see on your screens, we're down 0.4 of 1%. I'm just looking at turnover very quickly here, just to give you a sense of how heavy things are in the first 30 minutes of trade. And guess what? Again, here we go, nearing 900 billion renminbi in turnover. 3.3 trillion was the full day figure yesterday. So again, very, very busy trading so far. The big names on your screens coming up shortly are some of the big names that we have been tracking going into the session today, and certainly just goes to show like the massive rally we've seen in many of these names. Cambricon Tech is really one stock that we've been tracking only very recently. I can guarantee many of you have not heard about the stock up until this week. We're down 4% on the stock itself. Hua Hong Semi's unchanged. Vanco limit up, I believe, yesterday. If not close it out, we're down about 3% as far as A shares go. Right, the broader read across the Fed conversation with Donald Trump moving to fire Lisa Cook. S&P futures are down, maybe not because purely of that. There's also the tariff story to tell you about, but I can certainly tell you the dollar and rates have been really more a function of that story, with the dollar weaker. And as you can see, the 2s and 10s curve right now at the steepest, going back, I believe, 4 months at 59 basis points above zero.
All right. Certainly that's a lot to talk about here and unpack, right? Because obviously we have to talk about, whether there was cause in all of this, of course, to this move to fire Lisa Cook, but also what does this mean for when it comes to the dynamics within this FOMC board now, where if Trump succeeds, we're talking about 4 governors potentially that are going to be aligning with his view, whether it's going to be a question of Fed independence, that's still kind of up in the air, right? Yeah, and the economy also kind of needs to cooperate, I guess, with any stronger case to cut, right? So there's a really good quote right now in the Bloomberg story that talks about now the dust has settled from Jackson Hole. If you think about it, nothing really has changed because the Fed will still be dependent on these 2 upcoming reports, at least 2, right? So is there a hot enough number on the jobs report that makes them change their mind as far as the Fed cut is concerned? Or you push it back to October, right? Yeah. Let's talk a little more about that. Let's bring in our MLI strategist, Mark Cranfield. He joins us now. So we've seen a barrage of news, Mark, really, everything from tariffs reemerging and the threat of that once again to the removal of Lisa Cook by the president. Tell us what you think is really going on right now across these sort of markets.
I think what you're seeing is that traders are needing to price an even bigger risk premium for the US assets, which they feel will be most impacted by moves by President Trump or by the White House, the US administration in general. So the US dollar, the Treasury yield curve are certainly the ones that will be in the forefront of any action in that respect. So there was already some concern that the frequency of talking by outside voices to try and influence the Federal Reserve to lower interest rates, that was becoming more prominent already. Now they've gone even a step further. They're trying to oust a Fed governor, And investors are probably thinking to themselves, where will this end? Where do we go? How many Fed governors are in line here at risk? And what does it mean for policy? So all of those things undermine confidence in the independence of the central bank. I'm sure you've been discussing that a lot already. But you need to reflect that in some price action. So the places where assets most at risk, the US dollar in general, especially against G10 currencies, you would expect to see the US dollar underperform there. And then probably against places where people take more care about their currency, such as China. They're doing a very good job of stabilizing and making the yuan relatively strong. So that would be an outperformer on the other side. Then there needs to be a discount for the long end of the US Treasury curve, because the more you try to influence US policy in the short term, when the data may not support lowering interest rates immediately. That was Jerome Powell, sounded dovish, but it was very nuanced. He was still saying that he's data dependent to a large degree. Well, if you try and enforce lower interest rates before the data really justifies it, that will be taken out in the long end of the curve. You'll get an even steeper curve than we're seeing at the moment. So those are the places where traders are building in the risk of more things going wrong in terms of the US assets. Then they've got the stock market, which is a slightly different beast. You've got to worry about Nvidia and earnings and those kind of things. But you put it all together, and investors clearly are going to start to weigh things up and say, do we want as much money in the US, or should we start moving it to Europe, to Asia, to places where, let's say, policy is a bit more transparent than it might be in the US?
Okay, well, Mark, let's put all those things together, right? So on Fed pricing right now, I'm looking at let's call it 85% probability on Fed fund futures. Similar odds when you look at swaps of a cut in September. Now, you could make the argument that if they don't move in September, they'll simply move at the next meeting. But Mark, just tell me this: has anything changed though with the I wouldn't say full consensus, but the majority view there that the dollar will continue to still weaken from here?
It's pretty hard to see a convincing case for a rebound in the US dollar. When you just had at the weekend, Jerome Powell, it's going to be very hard to walk back the comments from Jerome Powell. He pretty much set up a September interest rate cut. There will be some disconnect among Fed speakers, but in general, he's got time to try and persuade them that, yes, they need this cut to give them some breathing space. So September is pretty much a done deal. That undermines the US dollar already. Then you've got, if you think of the spending increase in Europe, the fact that Japan is still heading towards an interest rate hike. BOJ Governor Ueda reinforced the moves over the weekend when he was in Jackson Hole. It wasn't an outright hawkish speech, but he's certainly nudging sentiment in the direction to say that the Bank of Japan is getting closer to the next hike, probably in October. That will support the yen and steepen the yield curve in Japan as well. So those things are all working. Plus, you've got Asian currencies are getting more support because of the money flows into relatively undervalued markets here in Asia. So it's very hard to make a case for the US dollar to make a serious rebound in the near term at least. And that probably takes us through pretty much close to the end of the year.
Okay, Mark, thank you so much. Mark Cranfield, out of our MLive team in Singapore for us. Let's get more insights really on not just what this means for Fed policy, what this means for the lineup of Fed governors, what this means for the path of the dollar. Is there a case actually for a cut in September? Bill Lee is with us right now, Milken Institute Chief Economist and Executive Director is with us right now. Bill, good morning from the Asia Pacific. Thank you so much, and I know we dragged you into the show very last minute, so appreciate the time, sir. You were formerly at the Fed. What do you think is going on as far as Fed staffers are concerned now?
Well, the surprising part of the story is that Lisa Cook herself didn't resign. The history of the Fed staff and all the governors and presidents who have served at the Fed Reserve as on the FOMC have always been held to a very high standard. We're all told you cannot do anything that would even look or smell of something wrong, regardless of whether it is wrong or not. We have examples, for example, with Rich Clarida, the former vice chair of the Fed, who resigned because he was doing some portfolio adjustments that were pre-programmed. That is, he already told everybody he was going to do it. And apparently the disclosure wasn't complete. He omitted one or two transactions, and that was enough to cause some sense of uncertainty about whether he was doing something wrong, and he voluntarily resigned. Robert Kaplan also has some stock transactions that he didn't fully disclose, and there again, he resigned. There was nothing wrong with anything these guys did, but nevertheless, anything that besmirches or potentially besmirches the reputation of the Federal Reserve and its integrity of the staff is something that the staff takes very seriously, and they all tend to fall on the knife rather than to cause any kind of harm to the Fed's reputation. And Eric Rosengren, the Boston Fed president, also had some real estate transactions that supposedly were behind his retiring. So there are lots of examples of very high-profile individuals that themselves took upon themselves to resign rather than to bring any hint of scandal to the Fed.
Sure, Bill. But what's the intention with what the president is doing? Do you think that it's in some ways Trump trying to control the Fed? And it seems like those concerns are really kind of bubbling up now.
Well, I think President Trump has always been concerned that the Federal Reserve just is not lowering interest rates quickly enough. Although, he also probably knows that it's the long-term rates that matter, and the deficit has more of an influence on the long-term rates than the Fed does. But nevertheless, the general atmosphere of lowering rates is something that he wanted to put in place, and the FOMC wanted to put in place. The issue is timing. But right now, with all of the commotions of Chair Powell being too late, Chair Powell already put that aside by saying we're ready to move. So there's really no reason for President Trump to just fire Lisa Cook just to get his way by appointing more members of the FOMC that are more dovish than hawkish. So I think this particular case of Lisa Cook really surrounds the integrity of the Fed's staff reputation and the Fed governors being squeakier clean than clean kind of atmosphere that he apparently wants to maintain.
Right. So, Bill, let's follow that specific sort of thought exercise. Now, do you think there is a case to cut, not just once, by the way, to cut successive times?
Oh, David, I mean, I've been saying that we could easily go 50 basis points at the last meeting. And the Fed's new operating procedures, right, for the next 5 years, the new policy framework, they were very clear to say that inflation expectations are the most important thing to maintain and to anchor. And we will let inflation as reported go up, say because of tariffs, or we can let the unemployment rate go up because we recognize that circumstances change what is normally considered the equilibrium level of unemployment. The natural rate has always been like between 4 and 4.5%. But Chair Powell said because of the changes in immigration laws and the changes in the productivity of labor and the demand for labor, the demand and supply are highly uncertain right now. So he's looking at a whole bunch of indicators. And that's what's going to make Fed watchers a very hard job going into the future because the new policy framework gives the Fed a lot of flexibility. They got rid of the inflation, the average inflation targeting regime, which is, will keep things higher than average. If things are below average, if they were above average, you have to keep these lower. And that's kind of a wishy-washy kind of way, which always was doomed to failure. And now they're much more specific. They say, look, we have full employment and price stability, and we're going to get there. And we're going to do whatever it takes to get there.
On inflation, though, what we heard from Jay Powell at Jackson Hole was that it might be it's not all at once, right? Because given what we've been seeing with tariffs and the like, that this looks like it to be something that is very slow moving, but maybe more persistent. Does that in any way change how they look at whether or not to cut interest rates or not? Because right now it seems like we're not seeing in the data, but it could be something that comes in waves.
The key is to keep an eye on those inflation expectations, and not just surveys, but the break-evens as measured in the financial markets. If those start to rise, then that will cause concern. But even if we have waves of tariff-related price increases, Chair Powell has made the brave move of saying, once again, I think those are going to be transitory. and we're willing to move policy in advance of what we see developing with tariffs because we're concerned about the labor market weakening, even though the unemployment rate itself isn't moving. So that's an example of the new framework at work. that gives the chair and the FOMC more flexibility to make the right decision, even if the traditional indicators are not all there. So I think even though, as you say, the tariff price increases will take a while to kick in, he's convinced enough that it will not lead to a dislodging of inflation expectations. And that, again, is you can get a daily reading of that or an hourly reading of that by looking at the break-evens in the treasury market or the swaps or however you want to calculate that.
Bill, do you think Jay Powell's job is safer now?
I think it's unlikely that he'll be firing Powell because there's really no cause. And now there's no reason because Powell already said we're ready to move. And if the next set of data on inflation are really hotter than what people expect, then it'll be 25 basis points. If it's cooler and we have some weak payroll numbers, it may well be a 50 basis point cut, which I would vote for if I run the FOMC.
Right. Bill, just one last question for you, sir. If the jobs number comes in not extremely hot, but a solid jobs report, do you think there's a case for the Fed to hold? And do you think if the Fed holds, that in some way underscores their independence?
I think the one thing that we've learned now is you don't let any one data point push you around. You cannot make a decision based on one data point. Based on the data we have so far and the likely number that comes in at the beginning of the month, the Fed will move. So I think and given the lack of certainty and data revisions associated with payrolls, no one number is going to be decisive. And if it was incredibly hot, like 150,000, 200,000, I would tend to dismiss that more than anything else. If it was 20,000 or negative 20,000, I would tend to dismiss that too, because again, the quality of the data are so poor, I cannot, and the Fed will never make a decision based on any one data point.
Bill, thank you. Bill Lee there, Milken Institute's chief economist and executive director, joining us from Henderson, Nevada there. Coming up, Fortescue CEO Dino Otranto joins us after their full-year profit narrows as China's property slowdown hits iron ore demand and prices. Look at the outlook. Coming up next, this is Bloomberg. All right, we're looking at Fortescue shares here this morning. We're down about 1.5%. The world's fourth largest iron ore miner says its full-year profit fell 41% due to lower prices as demand from China plateaus. Revenue and final dividend were also down compared to last year. And right now joining us is the Fortescue CEO, Dino Otranto from Perth. Dino, it's great to have you. Thanks so much for the time. Obviously, it's been a challenging year, whether it is scaling down your green hydrogen business into, obviously being hit by the lower prices of iron ore. Tell us what stood out to you.
Yeah, look, as you've called out, we have been impacted by a downside in the iron ore price on the full year. However, our underlying results that we announced today were exceptionally strong. Meeting guidance at the top end on both safety, production and costs, and at a price point of around $100. It's a really good price for us as a business. We also announced a dividend of 65%, right in the middle of our range, and we understand how important the stability and certainty of that dividend is, and that really underpins a lot of the decisions we're taking on our growth option portfolio.
Dino, you mentioned the magic number there, which is 100 on the price. And I wonder, given, I'm not sure how the best way to describe it, but some would call it weakness in the market, why do you think prices have remained fairly stable at a fairly elevated level?
Yeah, look, I mean, I heard the term weakness around the market in China, and I've heard it for a number of years now. I frequently visit China. I'm heading there this evening again, and every time I'm just in awe of the development that continues to go, really unwavered. What we're also seeing is a much more diversified and mature sector, really growing out of what drove iron ore demand, which was the property sector. You're seeing that somewhat plateau now. and it's being more than replaced by automotives. You're seeing the EV penetration in China, just phenomenal rates, and most recently the announcement of the mega dam project on the inner west of China, 3 times the size of the Three Gorges project, which we thought was the biggest project we'd ever see. 3 times will spur growth over the next 10 to 20 years for commodities like ours. And I think that really is the story around the price support that we're seeing in iron ore.
Dino, I have to ask you then, are you seeing, I know it's very early because that's a multi-year project, if not more than a decade, but are you already seeing a pickup in interest in your product because of that specific project? What are you seeing specifically, if any?
Look, I think it just talks to the general sentiment of the market. And I think when you get outside of China, there are more doom and gloom commentators around the iron ore market. When you get into China, we're still seeing our product suites flow. They're very liquid. They're enjoyed by our customers. Most recently, we had a roundtable hosted by our Prime Minister in Australia and the head of state, Premier Li in China, with mills and iron ore producers discussing the current business, but also the future business around greening the supply chain, which was very, very encouraging. And that's where mega projects like this enter into the arena.
So Dino, are you confident then that Beijing has the right policy settings and tools in place to really kind of boost demand in China?
Well, for me, it's not only future directed policy and regulation, but what we're seeing on the ground now. Last year alone, $1 trillion of investment in the energy transition. That's more than 400 gigawatts of solar, wind, battery, electrical infrastructure. All of that requires a lot of steel. And I can see that continuing now for the next 10 or 20 years as China commits and really doubles down on its peak carbon emissions. Many would say that it's already reached peak carbon emissions, and the downward trajectory over the next really generation that we certainly encouraged by the supply into that process for iron ore and some of the other businesses that we're involved with.
Yeah, Dino, I'm glad you underscore that, because from a demand perspective, that's really not as appreciated in the market, so thank you for doing that. They've also been tinkering with supply, this whole anti-involution campaign. We talk about it a lot here in shows on the consumer perspective, but, the steel mills, for example. I wonder, what you're hearing from your contacts in mainland China as far as steel capacity is concerned, and what's your outlook there?
Yeah, certainly a new word I've had to add to the vocabulary, anti-involution. Finally understand what it really means. But for us, from the demand side of the steel mills, you are seeing some structural reform, which is largely expected as the blast furnace enter now into the retirement phase and being replaced by electric arc furnace. Also a vision around China around moving some of those higher emitting polluters outside the country or further away from the mega cities of Shanghai and Beijing. On the supply side, I've always maintained the view that iron ore mines will get lower and lower in grade and smaller in sizes. So big projects like Simandou, our own project in Gabon, become more replacement in nature than adding more supply side pressure. So we believe that the market is quite well poised for largely a sustained price support model over the next 5 to 10 years. Right. And that, like I said, that's a great price point for a company like ours.
And Dino, it seems like in the mining industry, there's a very big high capex environment right now. We've seen that with your peers like BHP, like Rio. They're spending when it comes for growth. Fortescue has been spending, but a lot of it has to do with your decarbonization plans. I'm just wondering, how much focus are you putting onto growth now?
Yeah, look, for our organisation, it's always been about growth. Certainly, the last 5 years, we've doubled down on many different growth options, really suited to the energy transition around the world. We have an extensive list of exploration options in copper. Also on the energy generation side, as you rightly point out, our investment has been focused here in Australia to decarbonise our terrestrial operations, real zero by 2030, to be the first industrial leader in that space. And we're doing it because we believe it's economic. And the market is certainly starting to indicate to us that they are demanding a lower carbon footprint product, again, as evidenced by the decarbonisation roundtable we had in Shanghai with steel mills and iron ore producers.
There's been some, I guess, reports of people talking about some of the projects and delays with Belinga, this project that you have in Africa. Can you give us an update on how things are going there?
Yeah, so certainly our project in Belinga is not delayed whatsoever. We're most of the way now through a 3-year study commitment that we had with the government there. That consists of exploration and really defining how big this ore body is, and in parallel looking at the feasibility study of a rail and a port option in that part of the world. So absolutely not delayed. It's on track, meeting all our commitments, and we're getting increasingly excited about the potential of Mount Belinga. Maybe you talk to some of the public announcements we've made around Arizona and in Gladstone. What I'll add some colour on there is we really haven't changed our strategy around energy at all. What we have acknowledged, though, we went a bit early on the electrolyser manufacturing ability, and we've seen that really being taken over in a good way by China, driving the cost of electrolysers down. The environment in the US at the moment, as your program is rightfully calling out, isn't really conducive for that investment into green energy. So we're pausing that project. It still remains an option for us, in addition to many other options that we've created and cultivated over the years. And as those economic conditions in terms of the pricing profile, CapEx, government support in some of those countries come along, we'll pull the trigger.
Okay, so suffice to say it's shelved for now, but not completely.
I think those two projects, absolutely. We're doubling down on decarbonisation. Our green metals, green hydrogen project here in Western Australia is going full steam ahead. So I think those two in particular are on hold, and we'll pull the trigger as soon as the economic conditions prevail.
Thank you for clarifying that. Dino, final question for you, sir. You mentioned you're headed to China later today. I think, if I'm not mistaken, you guys were in China a few weeks back and secured this loan from Chinese banks. I'm curious, is that a deliberate move to diversify your funding sources away from, say, the U.S. debt market? What was the rationale behind that?
Look, it's actually surprised me we haven't done it earlier, to be honest. As most of our product goes into China, we have an RMB trading facility now. So it was really just a matter of time before the banks of China and our balance sheet were in a position to accommodate such a structure. And I think it's been called out as somewhat novel. It's been on the cards for some time for us. And the amount of interest we're getting from some of our competitors mean it's the right thing.
Yeah, not to mention, to your point, that borrowing costs that side of the world are probably on the lower side compared to elsewhere. Dino, do I take it then that you're open to more funding coming through from Chinese sources?
Yeah, look, we look at a diversified mix of lenders and financing options on our balance sheet. We are always open to land at 2% off the standard rate globally. Was a phenomenal result for the team.
All right, Dino, we're going to leave it there, but thank you so much for the time. Dino Otranto, their CEO at Fortescue, joining us live from Perth here this morning. We got some breaking news when it comes to Danantara. Of course, this is the newly established sovereign wealth fund in Indonesia. So it looks like they are sounding out investors on a plan to raise about 50 trillion rupiah. That's about $3.1 billion US in bonds from these so-called Patriot bonds, and the yields that they're quoting to people familiar with the matter are below market. So they're issuing or seeking to issue 5 to 7 year parts at 25 trillion rupiah each starting on October 1st. And that could carry a 2% coupon, according to our sources there. So that is going to be the latest there. We'll get you more details coming through once we have more. Back to our top story now. President Trump is moving to remove Fed's Lisa Cook, but Bloomberg Intelligence thinks she is likely to challenge her removal. Now, this is interesting. This is from our litigation team, right? So what they're is saying that there could be some kind of legal challenges moving forward, right? So this is their thesis. The path for Trump to control the Federal Open Market Committee is not easy. The Federal Reserve Act requires cause to oust Fed governors, and determining if that standard was met likely requires lengthy litigation with an uncertain outcome. Though a Trump win could influence the FOMC's makeup, as the FRB must approve in February 2026 the reappointment of Reserve Bank presidents who rotate onto the committee. We doubt a Cook suit would be resolved by then.
Yeah, but it also goes. So this is the initial reaction coming through from, as Yvonne was pointing out, our Bloomberg Intelligence litigation team, of course. The spin, I guess, which I think Billy from Milken mentioned earlier on, that there is a case anyway to cut interest rates, right?
Yeah.
So what surprised him is really more that she didn't resign by herself because of that you need an unblemished
Squeaky
reputation.
Clean. Yeah, squeaky clean reputation, as he said.
But yeah.
So, yeah, certainly that's one thing to watch, right, of how long this kind of, whether there's investigation and all that moving forward. So maybe they're saying that path.
And whether she'll challenge it.
For the Fed to, I guess, take control, they say, of the FOMC could be not that as easy as it sounds. We're checking markets here right now, and of course, we've been seeing a bit of a pullback on the Lisa Cook news. Certainly, that's one thing. President Trump also threatening more tariffs on when it comes to curbs on chips and the like here. Japan is looking like this as we head into that lunch break here right now, and we are seeing shares down about 1% on the Nikkei as well. There has been some rush into the havens like the yen, so we're at 147 levels this morning.
Yeah. I mean, there's really not a lot of reason to take on risk today, and certainly we thought the window was opened, and we didn't know for how long it was going to be open for following Jackson Hole. But certainly the case today is, again, news flow is back out of Donald Trump, and volatility is back as far as that's concerned. So 0.6%, and separately, and perhaps now more related to the story right now, S&P futures are down. The dollar is certainly catching an offer right now, and the Bloomberg Asia Dollar Index is also coming off a little bit as well. It's also good to mention that Nissan was a big drag in the morning session over in Tokyo. I think we were down about 6% last we checked, if not more. Right, now, speaking of, we're looking at these Chinese markets, right? So, I mean, name your superlative or name your favorite overheating indicator, and you probably ticked that box yesterday going into the onshore markets. I am just, as you look at this, and you're going to bear with me here, I'm just going to look at turnover about an hour into the session here onshore. So we're down about 4, let's call it half of 1%. On the tech gauge, Shanghai Comp is off a third, CSI is off about 0.6 to 1%. I'm going to call on my producers if they could. If you guys could pull over I want to see what Cambricon is doing along with the other big movers like Hua Hong and Vanke, which were the main drags there. And while they're doing that, an update here right now. The turnover.
1.2.
1.2. Okay, so we did cross the trillion renminbi mark. So I wonder what the financials are going to look like when they report earnings. There's certainly a lot of flow coming through. Right, so here's one stock you probably didn't hear about up until recently.
Even for us, right, that we have to actually check this stock.
Yeah.
Pretty much daily now, Cambricon, right? So these are some of the chip makers in China, and this is one of the ones that has become a favorite among investors here, whether you are buying the whole AI sort of theme, right? I think Goldman was the latest to raise that price target by 50%.
1,800. 1,800 a pop, yeah. Well, it's only trading at 4,500 PE now, so that's current. If you extrapolate it down 12 months, that goes down to 290, I believe, so more palatable. There we go. But this has been really a momentum play more than a valuation one, more than anything. Okay, let's get a sense of where we are right now and how we're looking at coverage around this Chinese market. Joining us here on set is Jeannie Yu, our Asia Stocks reporter, for more on the story here. Yeah, so how are you guys looking at this rally? It's been hard to catch up.
It's really hard to catch up, and we do wonder where we are in this cycle. We keep asking people where we are in this cycle. Are we going to see another record for Hang Seng? But so far, I think the sentiment we're hearing is that a lot of people they're telling us, with so much liquidity sitting at the Chinese banks by the retail investors in mainland China, there could be another leg up, driven by those retail monies in the Asia market in particular. So we're talking about 6 to 7 trillion excess liquidity at Chinese banks. And we are starting here to hear those recommendations from strategists, again, like we did back in 2015, when they're saying, those money could be switched from those Chinese banks to the equity market at some point as the rally goes on. So, yes, indeed, we're seeing a lot of signals suggesting, the market could be getting overheat, some trades are getting crowded, but still, people are still betting on extra liquidity boost into the market. And then the second thing is the earnings season is not bad so far. So if you look at, for example, if you look at Tencent, look at some heavyweight earnings, it's not too bad. So it kind of gives us people, theories about, some fundamental improvement in terms of corporate margin, and also with the anti-evolution, pledges by the government, there could be less concerns about the deflationary risks in China if they really want to curb the prices and boost the consumption. So adding that up, I feel like the sentiment, like the momentum is still there. So we're not seeing, much like downside risk emerging in the near term.
You're watching Chow Tai Fook in particular, this stock. It has become one of the city's most shorted stocks. Can you tell us what's going on there?
Oh, yes. I think shorts have been rising against a lot of, hot stocks so far this year. For Chow Tai Fook, I think its share price has more than doubled, and it has conducted its first ever fundraising activities by issuing a big amount of convertible bond in June this year. So I think a lot of delta hedging is going on, and the company has already pledged, to buy back their shares, kind of to offset the pressure of convertible bond issuance. But the problem is, with the shares keep rallying, so if you are holding a delta neutral portfolio with the shares rallying, you have to short even more stocks. So that means like the investors they have to go to the market and borrow more stocks to sell to maintain their positions. So that's what we're seeing right now at this moment, like making Chow Tai Fook one of the most shorted stock in the market.
All right, Jeannie, thank you. Jeannie, you there, Asia Stocks reporter. Let's talk a bit more about the M&A space here. So there's been some news, right? Particularly when it comes to the Pinot family has reached out to potential buyers for Puma after the sportswear maker lost half its value over the past year. Now, sources say bidders do include the likes of China's Anta Sports and Li Ning, along with U.S. firms and Middle Eastern funds. Now, Puma shares closed up 15% in Frankfurt, their biggest gain in more than 2 decades. I'm checking to see if Anta and them are actually moving as well, but certainly it's a very interesting sort of story. There has been, more in the deal space, really. A new report from PwC has found that China's M&A deals in the first half surged some 45% in the first half of this year. It really has been led by strategic domestic investments. Let's bring in someone that has been looking into this, Thomas Crasti, PwC Hong Kong M&A advisory partner. He joins us here in our studios. It's great to have you, Thomas.
Thanks for having me.
Tell us about what's really driving this surge.
Yeah, so as you pointed out, right, domestic strategic M&A is really kind of the backbone of this 45% increase. We saw strategic M&A within the China market grow twofold, right? It went from 50.7 billion to 100.7 billion over the first half of 2025 versus the same period last year. But I think what's really interesting is to actually think about like what's driving that change, right? If we look at the last couple of years, fundamentally what's been the major blocker of getting deals executed has been the valuation gap between buyers and sellers. If we look at what's driving this change at the moment, the rising valuations we're seeing amongst the share prices across the Hong Kong Stock Exchange, across the China A shares, the rising capital market activity, particularly we're seeing here in Hong Kong, we're seeing that really act as a catalyst to bridge that gap in valuations and really cultivate deals being done. And I think that's really the fundamental change that we're seeing, which is driving the M&A activity we're seeing in China at the moment.
Yeah, finally a matching, a closer of that bid-ask spread. Finally,
Indeed.
The piping's been fixed.
Indeed.
What about the financing parts? How has that also evolved alongside, of course, better better matching of prices right now.
Yeah, I mean, look, we're still seeing the private equity landscape as being tough, right? It's no surprise that there's a massive pent-up demand of M&A activity with private equity sitting on large value of portfolios which need to come to market, right? I think a really interesting data point that we're starting to see is that the number of PE exits in the first half of 2025 is starting to rise again. And our predictions are that the annualized number is going to be up to the highs that we saw in 2022. And again, the fundamental driver behind that is that bid-ask spread is reducing. So along with the pressure from LPs wanting liquidity amongst their private equity investments.
You mentioned strategic domestic investment. I'm just wondering, there's been so much talk about anti-involution and the need to bring down competition and really kind of try to consolidate some industries. Are you seeing a lot of that now?
Indeed, right?
Yeah.
You look at the data.
What sectors,
High tech, so semiconductors, right? So again, driving the government policy about really trying to invest into the semiconductor, the high technology, the AI investment. That's really what we're fundamentally seeing driving this M&A activity in China. Again, it's the consolidation. The data suggests that a lot of the M&A activity was driven by A-share, SOE-listed companies. So again, they're moving away from becoming the behemoths. They invest in everything and really starting to narrow in on what are their core competencies. A lot of the mega deals were very much centered around consolidation.
What other sectors? You talked about semis a little bit, I think, there in AI. Is there any other thing that stands out to you? Because from a policy priority perspective.
Yeah. I mean, look, I think it's AI, as I said, it's still health and pharma, right?
Okay.
Yeah.
I think consumer is struggling at the moment. But again, that's where we're seeing a lot of attention. And again, I think that's mirroring with the financial sponsors. They're very much invested in services, healthcare, education to a lesser extent.
What about outbound M&A for some of these Chinese firms? How's that looking right now?
It's still sluggish, right? I think kind of early signals we're seeing, particularly in our business, is it's starting to rise. But I think the real interesting trend is not so much the strategic outbound M&A, but the financial sponsor outbound M&A. Historically, we've seen sponsors in China very much focused on investing in the China market. But there's this new and emerging theme at the moment of China-headquartered asset managers, private equity funds, that have had to really pivot their strategy away from domestic-orientated deals and really pivot that to more of a regional and global focus. And I think that's going to be a key driver of outbound M&A alongside the strategics as they start to participate more and more in the M&A space.
And what do you suspect is the motivation behind that sort of push out?
I think a lot of these funds, they've got a large amount of US dollar capital. And as we know, right, it's hard to deploy US dollar capital into China. We're seeing continued growth of renminbi funds in China. But those who are sitting on large amounts of US dollar dry powder that have the expertise in investing, it's them we're seeing them pivot to more of a regional and global focus.
Right. And are there specific geographies that stand out to you where that money is starting to show up?
I think Southeast Asia is definitely one, and Europe at the moment, right? I think US is still a little bit sensitive, but Europe and Southeast Asia, obviously.
In terms of, do you have any projections of how things look? Even when it comes to just deals, transaction volumes and the like, I think we're still not quite near the peaks that we saw back in, 2016?
Correct.
And 2021.
Correct.
Are we likely to get surpass that, you think, or get back to those levels?
I think in time we will, right? I think the big uncertainty at the moment is the tariffs, right? We saw really good momentum leading into Q1 of this year. Liberation Day, tariffs comes out, halted everything. Boardrooms and investment committees, they're just struggling with the uncertainty at the moment. So I think as that starts to play out and there is a bit more certainty, where they land, it's anyone's guess, right? But I think the certainty will ultimately drive more activity. Whether that happens in back end of Q3 or Q4 or pushes into next year, I think it's anyone's guess. But I think that demand is there, right?
Hong Kong has an exit strategy because the market's been doing well, has seen tremendous progress. Are you seeing anything onshore, for example, in the Asia market, and whether or not we will see that listing market pick up because of what's going on the last few weeks?
Yeah, I think we will, but again, it's going to be very much domestically orientated businesses, right? I think we're seeing a lot more activity in Hong Kong, obviously, because people want to attract the international investor community.
Okay, fantastic. Great to see you.
Thank
Very
you.
nice report. We could get into most of this thing, but yeah, I think we'll be here until the next version of this comes out in 2026. Thomas Crasti, the M&A advisory partner at PwC here in Hong Kong. They recently just put this out just this week. Plenty more ahead here on The China Show. Right, welcome back. You're watching The China Show. President Trump has refused to change the terms of South Korea's tariff agreement, despite lobbying from President Lee Jae-myung during, of course, their first in-person meeting. After talks at the White House, the two leaders did agree to cooperate on security issues and also shipbuilding.
We're going to be buying ships from South Korea, but we're also going to have them make ships here with our people, using our people. And we're going to go back into the shipbuilding business again.
Let's bring in Stephen Engel, our Chief North Asia correspondent. He's here with us, and that was quite a long and varied briefing as far as topics that they eventually covered. But so where do we stand as far as the relationship between the two is concerned?
Well, it could have gone pear-shaped because the tone beforehand sort of set it up for a confrontation, because Donald Trump had put out some tweets, or not tweets, Truth social media posts, essentially calling out the political uncertainty and the chaos in South Korea, and he was unsure whether they could do business with the South Koreans. He also raised concern about reported raids on churches. So it could have started off badly, but I think President Lee came in with a clear plan, a bit of a charm offensive. He complimented Donald Trump for the, helping lift the U.S. stock market. He even complimented on the rather gilded,
gold, right?
Yes, the gilded nature of the Oval Office with lots more gold, and essentially praised him for a number of things, including Trump's peacemaking efforts. I think that set the tone right off the bat, pretty in a cooperative tone. It was cordial, if not friendly. And again, there's details that need to be fleshed out on the pledge that the South Koreans have given in that last-minute July trade deal, which basically lowered the tariff, the threatened tariff, from 25% on South Korean goods to 15%. And as you rightfully said, Dave, President Lee came kind of looking to reduce that, if not remove that. Trump says we stuck to our guns. They did not do that. But we're still trying to get more details on that $350 billion worth of planned investment in the United States. We know Hyundai Motor is going to up its investment by $5 billion by 2028, and also Korean Air is buying 103 Boeing jets.
Trump also wants to meet the North Korean leader once again. What do we get on that?
Yeah, that's right. I mean, he actually says he'd like to meet him again this year at some point. We do know Donald Trump has agreed to go to South Korea for the APEC meeting in October. I'm not saying that it's going to happen then. A lot has happened, obviously, since Donald Trump's first term. Kim Jong-un has been emboldened, if you will, by the Russian war in Ukraine because of the military partnership between Russia and North Korea. So a lot has to happen. But again, President Lee asked him to be the peacemaker and perhaps reach out to Kim Jong-un. So that is something we do need to watch out this autumn.
Steve, thank you. Our Chief North Asia correspondent, Stephen Engel there. Meanwhile, also President Trump is also threatening to impose new curbs on advanced technology and chips. Now, this would be a retaliation against other nations' digital services taxes that hit U.S. companies. Let's bring in our Asia tech correspondent, Annabelle Jewelers, on what we can start with. Give us some context behind this. Why are digital taxes such a pain point?
Yeah, well, they've been a pain point for President Trump really for quite a long time now. Even during his first administration, for instance, he was talking about tariffs on countries that impose digital service taxes. So just sort of in brief, a digital services tax is taxes that are put on tech companies that generate revenue from users in a particular country. So whether that's online advertising, streaming, the sale of data, and more. The issue is that obviously as the economy becomes more digitalized, you've got countries or companies that are generating revenue in countries where they don't really have a large bricks and mortar presence. And so the idea is that essentially is not fair. You can see here, for instance, France introduced a digital services tax back in 2019, and every year they're continuing to increase the revenue that they make from it. President Trump's point is that really unfairly discriminates against U.S. tech companies, and that's what he's been on social media this morning talking about, proposing new tariffs, export restrictions on advanced tech, semiconductors, if these digital service taxes aren't removed.
And what's this all got to do with China? Is there a connection?
This part wasn't so much clear cut, but in the social media post this morning, he was making the point that this gives, and this is quoting, but a complete pass to China's largest tech companies. So that's his point, is that digital service taxes unfairly discriminate against US big tech, and they give China a free pass, as he said. So I did find some interesting research from the Information Technology and Innovation Foundation that sort of bills itself as a non-partisan think tank that's based in DC, and their argument in a nutshell is that digital service taxes are aimed at taxing revenue from the largest corporations. Right now, Chinese tech companies don't have such a large footprint in the EU, and they're particularly focusing on the EU, where we see most of these digital service taxes, particularly focusing on them there, and they don't have such a large footprint, so it kind of gives them a bit of a second mover advantage, because they can kind of just sit back, watch how US companies adjust to the tax environment, and then plan their market entry and expansion around that. And so, again, perhaps not a level playing field. That would be the point that ITIT or ITIF is making, and maybe the point as well that President Trump was getting to in his social media post this morning.
Belle, thank you. Well, you learn something new every day, certainly. That's certainly true today. For me, Belle, thank you so much. Belle Drewler's there. Now, more on trade news coming through, and this is according to the Journal, is reporting a senior Chinese negotiator is reportedly heading to Washington this week for what could be the first round of negotiations in the U.S. Capitol. That is, as we point out, according to the Wall Street Journal, which says Li Chenggang will meet with Trade and Treasury representatives later this week. Now, the report comes as both sides extend their pause on higher tariffs through early November. Plenty more ahead. This is The China Show. Welcome back. Before we go, just a check on some names about 90 minutes into the cash market session. We've been tracking very closely, and some names that have seen a massive amount of money come in. And, Cambricon Technologies is really one example with an RSI of 91, and the stock's up 550% over the last 12 months. A lot of that very recently, but certainly 550% is a lot all throughout the 12 months. But yeah, we're seeing a pullback as far as that's concerned.
Yep, and we might be seeing a pullback when it comes to India here today, but futures are flat here right now. But we did hear from President Trump reiterating that, and signaling that those 50% tariffs could hit India soon. So they're talking about August 27th, I think 12:01 midnight is when those tariffs go into effect. So that basically brings it to one of the highest among some nations in terms of tariffs, and even higher than China.
Yep, so something to look ahead to as we move into that specific deadline and how quickly things have actually changed. Was that on your bingo card as of last year? We'll see you all tomorrow. That's it from us here on The China Show.